Sven, thanks very much for joining us this lunchtime. There's so much news going on. It's very difficult actually to get any sort of strategic thinking because we're getting pushed and pulled from one set of headlines and one market up day, one market down day to the next. It's an extraordinary time, isn't it?
Well, it is. Interestingly, just recently I was discussing with someone and they were saying, you know, what about volatility? Isn't volatility a huge risk? And I mean, volatility is a risk, but I think as an investor, a bigger risk in volatility is actually a risk is returns. You know, and if you look at emerging markets, 20 years ago, people didn't want to go into emerging markets. They said they'd be more volatile, there'd be more risk because of volatility. But if you look over the past 20 years, investors in emerging markets have had more volatility, but they've also had much higher returns. And it was a good thing to go into emerging markets because you're probably 70% above where you would have been in developed markets. So I think you have to be quite aware that you hear a lot of noise, there's a lot of volatility, and people are concerned that volatility is your enemy. But I think volatility is not your enemy, it's the longer term returns that are actually what you need to achieve.
Yeah, exactly. I think volatility is a very short-term phenomenon. I was talking to somebody about this very subject, and okay, so one day we're up, one day we're down, and okay, you get a little bit too much caught up in the day-to-day stuff which promotes volatility. But in the long term, as you quite rightly say, I mean, never mind America growing at whatever it is. We've got the US flash GDP number coming out at 3:30 Central African time, 2:30 Central African time this afternoon. But never mind America. Have a look at Ethiopia. Have a look at Angola. Have a look at a few other of the frontier African nations and look at their GDP. And maybe that's where we should be looking. Never mind Europe. Let's get our strategic thinking around investing in a continent that is suddenly starting to fulfill its potential.
Yes, I mean, not just GDP, the things that stand behind GDP. If you look at Africa, most of the countries don't have too much debt, so they're able to put money into infrastructure. If you look at where they are in terms of their population structures, with more younger people joining the workforce and being educated, they're ripe for a demographic dividend, and they're starting to see the benefits of that. And also, just the fact that Africa has less infrastructure than other parts of the world is an opportunity for an investor, because, you know, if you look at a place, just look at America, you know, over the past couple of sort of 4 or 5 decades. First, they put in a railway line network, and that grew America. Then they put in a freeway system, that grew in America. Then they put in IT, and that grew America. Now Africa's sitting in a place where we can put in the railways, we can put in the roads, and we can put in the information technology infrastructure. So the growth is really positioned in places like Africa where things can move ahead.
Yeah, indeed. I think the infrastructure is one of the key tenets, facets of the future growth of this continent. I was talking to Michael Power yesterday, who travels to China a lot, and he talks about, you know, you've got a passenger railway crisscrossing China, and next to it is a freight railway, and they stretch for thousands and thousands of kilometres. That same thing can happen in Africa. How do we play this, though, Sven? I mean, do we play the game where we look at internationally well-known blue chip companies with developed world headquarters that play in the frontier markets, or do we go straight to the frontier markets and pick up smaller companies? What's the best way to do it?
Well, you know, obviously there is an opportunity if you're going to buy sort of a company listed in Europe and America, and they have a certain portion of their business coming from a fast-growing area like Africa, and sometimes their growth is coming from there. But the problem is that, you know, that while, for instance, they might be getting a lot of their growth from there, they might only have 4 or 5% of their business from there. So even if that growth is sort of 30% on that 5%, it's still only 1.5% extra on their business, and the rest of their industry is sort of in the slower growing developing markets. So we think there's an opportunity to go straight into these markets, to go to companies that are listed in Africa, and companies also that are listed in sort of the UK or the US, but their operations are in Africa, and derive directly from that growth. Sometimes these are going to be companies run and owned by locals, which are growing there, and other times these will be companies where the largest shareholder is actually that international company that we were talking about, like a Heineken, Unilever, or Diageo. And these companies, they have operations in Africa, and they've been in Africa for over 2-3 decades sometimes. They've been making money, and we just think it's an opportunity if you take a portion of your portfolio as an investor and you put it directly into these fast-growing areas.
Yeah, if you're slightly sort of not Afro-pessimistic, but sort of slightly risk-averse, and you're worried about things like liquidity, though, I mean, look no further than SAB Miller, which came out with a trading update yesterday. A lot of that was increasing their lager volumes was because of their frontier markets or emerging markets exposure. PPC going into Ethiopia this week. We covered that story on Power Lunch, investing $21 million with the IDC, I think it was. So there's two ways of doing it. The one thing I would worry about in going into certain African stock exchanges is the lack of liquidity. Is that a barrier to certain investors going into the markets we've just spoken of?
Yes, I mean, I don't think it's a barrier, but I think it's something that we need to be aware of. It doesn't change our investment thesis, where we look for companies that have very high quality, we think of low risk, and we want to buy them when they're as cheap as possible. But what it does do is when we're putting together our portfolios, we're always very cognizant of liquidity. We don't want to have too much in any one company because we need to manage that liquidity, and we need to expand our investment horizons a little bit and put a few more stocks into our portfolios to cater for the liquidity. And at a level, and we're not sure exactly where the level is, but we think it's around $200 million. We wouldn't want to have a publicly traded like unit trust in these markets where people are able to get their money out within sort of the same day, because we think liquidity is an issue. But there are other ways for people who have longer term money to get more involved as well and put other amounts there. So it's something that has to be taken account of, but I don't think it changes the investment thesis for Africa.
What about unlisted companies, Sven? Is that a viable proposition?
It is a viable proposition. You know, in these, just the other day we were looking at a company in Kenya, which is it's basically built up from a single mattress company, and it was called Nakuru Mattress Company. Now it's called Nakamat. It's one of the largest retailers in Kenya. It's unlisted. They keep talking about coming to the markets. People are always interested in coming to the markets, but there are lots of companies like that. And we think that unlisted is an opportunity in Africa. But unlisted, of course, you know, in terms of liquidity, you have no liquidity in unlisted. It's a matter of negotiating an entry, watching your investment, making sure the right investment, and then negotiating an exit. Some of that exit will be to maybe a trade party who wants to buy and get into that sector, and some will be onto the stock market. So there is an opportunity for people who want to tie up their capital for between 5 and 10 years to talk about private equity in Africa, and the returns are good. Actually, I think
exactly, and you'll of course people like your organisation Renaissance, by investing in the non-listed companies, immediately raise the profile of that company, and then therefore its business grows, or potentially grows anyway, and they can consider a listing, whether it be in their own geography or maybe even onto the JSE. I mean, that must be a goal of the JSE, is to have more African companies listing, whether they're in South Africa or not, but listing on the JSE Securities Exchange. What do you like at the moment? We talk about frontier markets. Let's focus on Africa. Which particular geographies are catching your eye?
Okay, well, we've seen some interesting opportunities in Kenya. We've seen some in the banks and some in the consumer goods. Kenya for us is not just Kenya. Kenya we think of as a regional play because it's probably in Africa, it's probably the best integrated region at this point in time, East Africa. It's had a history of being integrated in the past. The integration sort of came off the table for a while, but that's really coming back now. So we think Kenya is interesting. And Nigeria still remains interesting. You know, we just saw an interesting article today where MTN has just announced they're going to put the latest systems into Nigeria. They're going to put things capable of carrying 4G in Nigeria. And data in Nigeria for MTN grew 100% last year. Now, we're not just talking about MTN here. If data is growing 100% in any one country, think about all the other opportunities that are growing there as well. So we think that there's a huge opportunity still in Nigeria. Interestingly enough, on a smaller scale and something which you know you wouldn't have as a main portion in your fund, we look at something like Zimbabwe. The UN has, or not the UN, but the EU has just announced that they're talking about reducing some of the sanctions that have been placed on Zimbabwe. Probably something that should have happened some time ago, because when you know the MDCA first came into power, it would have been very nice, or not into power, but into shared power. It would have been very nice if the EU would have given them something so they could show the benefits that they were able to produce for Zimbabwe. Instead, they didn't. So you tended to hamstrung the MDC a little bit in terms of that. So, but the economy, nevertheless, when they dollarized and in terms of the diamonds, the Zimbabwe economy has grown leaps and bounds and has been one of the best performing places to have an investment in Africa in the past few years.